Warning. This video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Alright, hello and welcome to Camel Finance. I'm your boy Camel, and this is your weekend's deep dive. Now, I'll be honest, I'm actually trying, I think, today to make this more of a shallow dive, and it's largely because I don't want to waste your time, I don't want to waste mine either. So what I'm going to do is just kind of re-outline the hypothesis as always, but because not a great deal has changed, I'm just going to kind of touch on things. And if you want an extensive and comprehensive deep dive, then you can go back and check last Saturday's video. If you've already seen that, then as I said, I don't want to waste too much time. I don't want to waste anyone's time at all. So let's just get straight into it, okay? In case you're brand new here, the base case hypothesis of the channel was that at the lows, we were too bearish and we were going to have this big run to all-time highs that ultimately rolled over. We had this big global recession, deflationary bust, and some tough times for risk assets for a while. All of this for the stock market was also occurring within the context of a much larger parabolic blow off top that goes all the way back to pre-2000. For Bitcoin, the idea was quite simple. And that was that we would put in an all-time high before the halving, and ultimately the top for this entire 4-year cycle would fall before November of this year, qualifying it as a left-translated cycle, something like this. And the reason for this is quite simple. We see this across all time frames with cycles. If we have 4 cycles chained together, whether this is yearly, multi-yearly, daily, weekly, hourly, doesn't matter. In a bullish uptrend, what we would typically see is the first 3 cycles right translate, meaning the top comes after the halfway point. Same for this one that we saw in the last cycle, followed by the 4th cycle left translating, meaning again the top forms before the halfway point. So this has been the expectation so far, more or less on track. If we fast forward to today, you can see the stock market, I believe, is pretty close to putting in that final leg to the upside. And of course, if it does start to go near vertical, it will have all the familiar symptoms of a blow off top, break down from there. And I would suggest that we will probably be seeing a recession, some kind of big global deflationary bust in the not too distant future. For Bitcoin, Bitcoin is slightly behind schedule. Bitcoin remains today the only missing component of this entire hypothesis, and that is that this third and final near vertical angle for Bitcoin is yet to arrive. And I know the temptation might be to look at this fractal and say, well, Camel, that is completely falling apart now, okay? And maybe that is the case, but I think what I want to show you very quickly is if I come back here and grab the fractal, which is where it's originally from, and we'll move the original one out the way for clarity, I would argue that each one of these components from this fractal is actually present. It's just this time around, each component is taking slightly longer. So if I align this to here, okay, you can see this first bit here fits quite nicely. But to make the next Bart Simpson type pattern fit, what I have to do is stretch this fractal out a little bit more, something like this. And now you'll see that this next component, the Bart Simpson, fits. Same deal here, more or less fits, okay? But by the time we get up into this chop range, okay, this bit here of the fractal, I have to then stretch this thing out one more time just to make it fit. So it's still there, okay? The components are all still there, it's just they're taking slightly longer at each time. And then again, we tracked for a while quite nicely, and up here, I wonder if what we're doing again is seeing another stretching out. So I wonder if this is just going to take a little bit longer than expected, and ultimately that third and final angle is going to come in the not too distant future. I do wonder if we're going to see something like this. I would think it's probably going to be more explosive and more violent and more vertical than this bit here. As ever, fractals are not to be traded off of, they are simply for illustrative purposes only. And whilst this may well be the start of the end, whilst that may well be the top and we may well be about to crash all the way back down to the lows, okay, I stand by the idea that this isn't actually too far from reality. The reason I say this is if I take it off a log and use the 3 trend lines, okay, we've got the first angle here, which I think is absolutely fine. So far, we are yet to violate the second angle, okay? So again, so long as we can hold this, chop around a bit and then get that third and final push to come in, I know it's not a popular idea right now, but that's all we really need for this entire hypothesis to continue to be validated, to continue to lack a complete invalidation. If, however, as I've been consistently saying, we were to lose this second angle, okay, confirm with some failed daily and weekly cycles, then we got a true breakdown, then we got invalidation, then I have to hold my hands up and say, okay, this is something else, okay, I'm completely wrong on this. But all the while we're above that second angle, which we currently are, as you can see, okay, first touch, second touch, third touch. So long as we hold above here and then we see a third angle come in, then despite the fractal initially that I showed you, looking like it has completely broken, okay, which to be honest is what fractals do, right? They're right for a while, and then when you need them the most, they tend to deviate away. But despite this looking very, very bad, as I just showed you, in terms of the 3 angles of attack and a parabolic blow off top, okay, it's yet to actually break down. So until it breaks down, it's kind of impossible for me to flip bearish. So as I was saying, more or less, we are in that neighborhood. Like I said, the only missing component is that third and final angle. But for all we know, that is coming any day now. Similarly, for all we know, it's about to break down. And if it does, then we know what to do, right? We have an invalidation and some reassessment to make. So in terms of the macro and the inflation, we are still working with this idea that anything you do to the M2 rate of change shows up in the US CPI with about an 18-month lag. So we saw a leg down, right? A violent snapback, a wobble, and then a leg down in M2. And this has corresponded so far with a leg down, a wobble in the CPI, which the market has been considering to be sticky inflation. And I have been suggesting that actually because this will lag in CPI by about 18 months, we are yet to see that third and final leg down in inflation. And thus, similarly to how a lot of the market doesn't want to believe we're in a blow off top and doesn't want to believe Bitcoin is capable of a third angle, a lot of the market doesn't want to believe that we're about to see CPI fall off a cliff as per the violent rate of change snapback that we saw in M2. But again, when we look at the TMC Global Credit Impulse, okay, this thing leads CPI by 18 months and it tells us to expect continuation of this inflation before a period of deflation. When we look at the actual CPI data, this doesn't include the most recent print. If it did, it would be somewhere in this neighborhood. And this looks an awful lot to me like down, sideways wobble before that leg down. So overall, so long as we continue to see cold prints, then happy days on that component at least. I also retweeted this yesterday where we've seen the PCE data come out, okay, and it is coming down. It absolutely is coming down month over month, 0% versus the 0.3, core at 0.1 versus 0.2, year over year figures below the prior readouts as well. So inflation for now apparently is continuing to come off. Again, not a popular narrative since a lot of people think sticky inflation is here to stay. A lot of people think that we're going to continue to see upticks in inflation. I'm still here to say until we see hotter prints, then I think it's only reasonable to expect cold ones. Of note, based on the PCE data we got this week, okay, if it wasn't for healthcare, we would actually be negative month over month. The Fed can't actually control what happens in healthcare, and so we can make the argument that the Fed has done its job. We would actually be in negative territory if we got rid of the healthcare data, which again fits this whole idea that we probably are going to continue to see inflation come off. And if, of course, we continue to see inflation come off, then the Fed can stand there and say, okay, we're ready to cut rates again. This, of course, leads me into my third point that most market participants don't want to hear, and that is that rate cuts might actually be coming sooner than most people think. The truth is, okay, the Fed was late to begin raising rates, and it's probably already late again to start cutting them. In red, we got the Fed funds rate, okay, and in blue, we got the PCE inflation rate. Now, what do you notice in the shaded areas that denote recessions, okay? Usually when we enter a recession, we see PCE fall off a cliff, okay? We see the same thing here. We see the same thing here, albeit with a bit of a lag. We see the same thing here. Halfway through the recession, we start to see the inflation come right off. We saw the same thing here, and inflation is already coming off. So if it's already coming off and we're about to enter a recession and they're about to start cutting rates, it's only reasonable to expect continuation of disinflation, which is typical and what we see during recessions. It's not until they actually start printing, then that money makes its way through the system, which again takes about a 12 to 18 month lag, that it starts to present as debasement and inflation. Not to mention, if all of this is occurring against a backdrop of people selling stocks and risk assets, what do they sell them into? Of course, they sell them into dollars. That puts a big bid under the dollar. The dollar continues to rise. And this is how we get that deflationary bust environment. So I would say overall, this is the biggest change since last week. Okay, it's the only real significant change. And it's one again in our favor. It continues to show inflation is coming off. It continues to show the Fed is probably already late to cut. And it continues to show that we probably are heading towards a deflationary bust, particularly if the stock market and risk assets continue to climb higher and higher and higher. The more vertical these blow-off tops get, the more likely they are to violate spectacularly to the downside. So overall, I would say, at least from an inflation perspective and from a stock market perspective, everything is moving in accordance with the base case hypothesis. I have no problem sticking with this. I have confidence in this read until it prints an invalidation. And as I was saying earlier for Bitcoin, this is the only missing component. But again, until it prints an invalidation and breaks down, then I continue to remain cautiously optimistic for Bitcoin as well. We've also been tracking the unemployment, and again, not much has changed, okay? The labor market is still a very, very difficult piece of data to navigate at the moment, since they continuously present data only to quietly revise it down a couple of weeks later. So despite quite clear and obvious deterioration in the labour market, the data is challenging to navigate, especially because they keep, as I said, revising the data down quietly a couple of weeks after they release the initial print. But the key point here is, if we continue to see temps come off, okay, historically speaking, that tends to lead the unemployment rate lower. We saw that in all other cases. Okay, and so I would suggest to you that if this continues to come off over the coming couple of months, we will see unemployment get worse and worse and worse. And of course, that again is synonymous with recessions. People right now cannot afford to lose their jobs. And if they do, then it's almost certainly going to push us into a global recession. And again, this is another factor in our favor that we are going to see these rate cuts show up much sooner than most people are actually ready for. Here's another look with US unemployment U3 in pink. Okay, and you can see Kansas labor market conditions starting to move higher, starting to lead higher. Okay, usually when we see this, okay, employment deteriorates very quickly. We see spikes in unemployment, and again, that is synonymous with recessions. As I just kind of touched on briefly, the consumer is not really in a good way at the moment. We saw Walgreens confirm that this week in a statement saying that they assumed the consumer would get somewhat stronger, but that is not the case, and their stock fell 25% as a result of this. Now, the reason this is so significant is we know the consumer is in a bad way. We know that they've got record high amounts of debt, and savings have dropped to below the 2020 lows. And on top of that, as I was just saying, if the consumer is about to lose its job, it's already in bad shape, okay, then all of these things point to a recessionary environment in the not too distant future. We're also seeing things like pending home sales, okay, dropped minus 2.1% month over month in May, slicing below the April 2020 recession level. So again, this is not nothing, okay? There is allegedly no recession coming, as far as most market participants seem to believe. Don't get it twisted, I am still suggesting that we will indeed see higher stock market prices in general. I am still suggesting we will probably see a third and final leg to the upside in Bitcoin. But ultimately, if we do indeed get those things, then again, we will have all the familiar symptoms of parabolic blow-off tops that are looking to violate spectacularly to the downside off the back of a global recession. And so a last couple of things I wanted to show you is that a lot of people say, no way, Camel, because liquidity is going to continue to expand. The liquidity cycle is quite early, and thus we've probably got a bull market that is going to continue to rip well into late next year as liquidity continues to expand. But this is absolutely not the case, as Henrik points out here. Liquidity was increasing the entire time into the great financial crisis, and they still had a very, very, very severe recession. So I am speculating that this time we're going to see a similar thing. Liquidity can possibly continue to increase through this cycle, but that does not make us immune from a recession and a downturn. Also note, as my brother Kemazabi points out here, 2006 at the liquidity low was the peak in housing, okay? Down here was the peak in housing. I think we've got a very, very similar situation today. I also think we've got plenty of investors that have been trained to buy the dip because they think this liquidity cycle is going to keep increasing, and that means that so is risk assets. But I am here to suggest that similarly to back here, we've probably already seen the top in the housing market, that real estate cycle that everyone points at to say, well, we're going to run well into next year. The whole idea that Bitcoin is going to do what it always does, which is run into a peak late next year before having a 12-month bear market decline, to me, all reeks of training and conditioning retail to be ready to buy all dips after we've seen that parabolic blow off top. And I'm suggesting to you that probably what we're going to see instead is a recessionary environment despite the increase in liquidity, and thus some very, very tough times for the majority of market participants. Keep in mind again, okay, liquidity does not drive the business cycle. The consumer drives the business cycle, and they are struggling, as I showed you earlier. And again, fitting in with this theme of ideas that are not popular with the majority of market participants, I still stand here and say, I think we're probably going to see cuts sooner than most people are ready for. And if you don't agree, then I have simply one sentence to say to you, and that is, tell it to the bond market. In green, we have the US 2-year yield. Okay, now what you'll notice is every time this moves lower, we see the onset of a Fed cutting cycle. I show this every week. Okay, we saw it in every single instance. And so I have been suggesting that the signal for when we're going to see cuts is if this US 2-year bond yield starts to move lower. If it does, it tells us that the Fed is about to start cutting rates. And I have been interpreting this as the bond market calling the Fed bluff. Whilst the Fed stands there and reiterates its rhetoric of higher for longer and no need to rush this thing. Meanwhile, the bond yields moving lower would be the signal to say that the central banks and the people that move the bond market do not believe a word that's coming out of this man's mouth. Meanwhile, if we take a look at the 2-year bond yield, okay, we are slowly but surely morphing into one of these looks. All we need to see, if I move this out of the way, okay, is a rollover and the start of a next leg to the downside. And we will have a look when we go back to this chart that has morphed into something much more like this, okay? And again, all we have to do is look left and see that historically speaking, this is the bond market telling the Fed, no, 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 you will indeed be cutting, and you'll be doing it much sooner than most market participants are ready for. So I maintain that this is the signal. Some level of counter trend bounce here could make sense, okay, before a rollover. But unless this thing is to invalidate by moving higher and breaking out of this resistance in red, then once again, I am here to tell you, tell it to the bond market. The bond market does not believe that we're not going to be seeing cuts in the not too distant future. And we're seeing the same thing with the 10-year yield, okay? So if this is just a counter trend bounce that rolls over, that is the signal that indeed what we've got is incoming rate cuts, despite the majority of the market not wanting to believe that. Again, similarly, invalidation would come if we were to do something like this and break out. All the while we have not done that, we are contained below resistance, we are making lower lows and lower highs. And once again, I am here to tell you, tell it to the bond market. And all of this, remember, is occurring against a backdrop of a dollar that continues to trend to the upside. With this level of relative dollar strength, if we do eventually see that stock market put in its final angle, violate spectacularly to the downside, also violating, remember, this long-term parabolic blow off top, as I said earlier, we will see investors and traders flee risk assets and hide in the short-term safety of the dollar. And this is going to drive the dollar into orbit. And of course, once we've got a highly bid dollar, we have all the familiar symptoms of a deflationary bust. Remember, against a backdrop of investors thinking inflation is sticky when in fact it is not. And it seems more reasonable to me, at least, to expect a period of asset price deflation. So as you can see, not a great deal has changed. No major invalidations have occurred. We are still pushing this daily cycle, waiting to see where the next daily cycle low forms, whether it can continue to grind a third angle or whether we have to pull back. As ever, invalidation comes if we start to lose this second angle, okay? Especially confirmed with failed daily cycles. Then we've got something else at play. If we were to pull back into this second angle and continue to grind it for a while, then I think the liquiditists have some merit to their argument. I think then we can start to entertain that perhaps my idea and my assessment that we are similar to the 2008 setup is perhaps wrong. And instead, there might actually be some credibility to this idea that we have got a longer than expected bull run. But if we continue to set this third and final angle, particularly if we start to go more and more vertical, then I suggest to you that the top is much closer than most people are ready for. And as I said earlier, the invalidation for this whole idea would be true technical breakdowns of this second angle confirmed with failed daily cycles. So far though, long and strong continue to push. We've done a really, really good job at hopping in and hopping out, capturing this entire move. When we move into the NASDAQ, you can see this thing's starting to look even more vertical. The Dow Jones is also starting to push up. Again, still kind of looking for a third and final angle to come in the not too distant future. We're even starting to see the breadth think about widening, okay? So is the Russell 2K going to finally get this push? We've been waiting for it for a long time. It seems to be wanting higher. So for now, at least, long and strong there as well. Gold is still more or less playing ball. It's trapping a bunch of people with fake breakouts, but the people that know about the cycles know the cycle remains down and it remains risky to be long until the middle of July. Of course, in the middle of July, I think that becomes the opportunity to find a weekly cycle low and for me to guide a bunch of the members through a bunch of metal and metal related mining positions, including some individual mining stocks. So a couple more weeks and I think it's about to be go time for the precious metal markets. And last but not least, we have Bitcoin. Like I was saying earlier, the only missing component is this third and final angle. It's not a popular idea, but frankly, that is how I like them. As I also said a bunch of times already, lose this second angle, okay? Particularly if we were to morph into a look something like this from here, okay? That would be a failed daily cycle. And then we would have to entertain that something else is going on. That might even be the top. In the best case scenario, we're going to do something like this into a weekly cycle, and then we can talk about a right translation, maybe. But again, I can see by the way people are reacting to me saying that we probably still have a third and final angle to come in here. This is not a popular idea at all, and that is exactly how I like them. So as I was saying over and over again, this remains the only missing component, but I cannot discount it until we actually hit invalidation by breaking down and seeing some failed daily cycles. For now, it seems like more or less we are into a cycle low, ready to move higher. And I will say this, in the level 3 member section, we cover about 10 or 11 of these crypto related equities, and the vast majority of those are sat well in profit and are breaking out to the upside quite explosively. So I am interpreting this as these crypto related equities do not think that was indeed the top for Bitcoin. It seems weird to me that that would be the top for Bitcoin, and the likes of BlackRock and the institutional traders were planning on trading this thing down. Meanwhile, they were putting these crypto-related equities into hugely bullish markup campaigns. So I suggest to you that since these are starting to move violently to the upside, we are about to see Bitcoin be marked up one final time as well. And again, once we get here, then we got third and final angle breakdowns, perhaps against a backdrop of the stock market being parabolic. And by the time we get into this neighborhood, I think we're going to start to see rate cuts, which of course aligns nicely with the idea that they would mark close to the top in the risk assets. And likely by then, we will have seen the bond yield signal this well ahead of time. So I'm your boy Camel. I'll be back next weekend. We should have some more data to play with. As I said, until the thing invalidates, then I stand with this posture. And here's to another great week. Here's to hoping we can finally see that third angle come in for Bitcoin. And ultimately, does it matter? No. What matters is staying on the right side, which I'm confident the Camel Crew will continue to do. If you're a level 3 member, look out for the video that's coming in just a minute. For everyone else, I hope you have a fantastic weekend. And until next time, take care from me. All the best. Cheers. Bye.